Welcome to our webinar series, Secondary Spotlight, that covers the dynamic world of the secondaries market. Here we explore the opportunities and strategic insights in the ever-evolving secondary landscape. Join us for a discussion with thought leaders that share their views and insights on a range of topics stretching from business, operational, to legal considerations.
Hello and welcome to our Arendt webinar series on secondaries. My name is Michael Jonas and I'm a partner at Arendt in the investment management team. And I'm joined here today by Julia Szafranska, Counsel in the same team. It is my great pleasure to welcome Marinus Schmitt, partner at Ufenau Capital Partners for this series. Ufenau Capital Partners has over the recent years had great market recognition of their practice. Just to name a few: German, Austrian and Swiss LBO fund at the Private Equity Exchange and Awards over the last years, Continental Regional House of the Year Award, Dach Deal of the Year in 2022, and Firm of the Year in Switzerland. Hello Marinus, it is great to have you today, and to start I would like to ask you if you could please shortly present Ufenau Capital Partners.
Of course. Thanks. First of all, thank you for inviting me to the webinar, Julia and Michael. Yes, about Ufenau Capital Partners. We are a private equity house headquartered in Switzerland, in the region of Zurich. For those who might ask what is that name coming from, Ufenau is an island in the Lake of Zurich, and that's where we are close. So that's where the name comes from, actually. It was founded actually 2011. My two partners, Ralf Loren, Dieter Scheif, and myself started the show. It was a small fund, 25 million at that time. We never changed our strategy. So since 2011, we focus on majority buyout situations of profitable small cap companies. We look in the service sector only. So this means asset light. The core of our strategy is actually buy and build. So we foster the organic growth with add-on acquisitions. We started actually with 25 million. It was our first fund. Thanks again for that. We worked with you there. And we were 3 people. Today we are over 50 people. We have 3 billion under management. Beside our head office in Switzerland, we have also offices in Madrid, in Amsterdam, in Luxembourg, just opened Warsaw, and there is more to come next year. So we increased our funds. We raised the multiple funds, main funds, and also continuation vehicles, while we're talking today. And today we have 3 billion under management. So since over a decade, we just do more of the same. Overall, we executed over 350 acquisitions. 35 are so-called platforms, so initial acquisitions, and remaining are add-ons. So that's in a nutshell about Ufenau.
That is a really impressive growth. And now moving on to the topic of today, which is secondaries, we wanted to start with your continuation funds, as you have raised 2 continuation funds, respectively in 2022 and in 2023. And we wanted to ask you if you can please tell us what were the main drivers for both deals from Ufenau perspective.
Of course. First of all, I think that continuation fund, how it's called today, I think it's the best innovation in the private equity sector when you're doing it out of the right reasons. So what was our rationale behind both funds? And actually, when we raised some funds over the last years, and we were limited in size. So when you do buy and build, it typically takes a while until you realize, will it be a success or no? And then when it is a success, actually it needs you to 4 or 5 years to grow these super small companies, starting with a group to then sizable companies. And actually, for both cases, for us was the case that we were running out of money. So we said, okay, either we can sell those assets to maybe mid or larger cap funds, and then they simply continue to do the same. But now, actually, as we established a company which is ready to scale, we have the management team in place, we have the infrastructure in place, we show that a group can work. we actually have to sell it. So that was the rationale. So we said, why not just transferring that into continuation fund? Besides holding it for 5 or 6 years, we can hold it additional 4, 5, 6 years. We know the management teams, we know what the companies is capable of, and then we can bring them, let's say, for example, we can double the size of the EBITDA or even bring it further. But in addition to that, we have the time to more institutionalize those companies. So this is in a general view, to summarize, it's, you're running out of money. Instead of selling it and let somebody else do the job, you can simply keep it and just continue the strategy which you started years ago for the next few years. So for us, that makes really a lot of sense. But of course, buy and build here is the core strategy.
Thank you for explaining the main drivers from your perspective, which I understand are mainly the absence of agency costs and the potential to offer your invested LPs with additional return. From the sponsor's perspective, would you say that there are still other benefits for GP-led secondaries transactions? And at the same time, on the flip side, could you explain what would you consider to be the major risks?
Of course. I mean, for the key benefits, I think they're quite clear. And the one is I just mentioned that you just continue to do the same strategy. That makes a lot of sense. You can remain in the driver's seat and continue the same strategy. Second, we know the assets very well, and they are very good performing assets. So that's what you call agency costs. It's really lower because you're actually reinvesting in something, for the last 5 or 6 years. Second or third of all, the management teams, them. That's a very crucial part. It's not only the companies, the team. For us, it's really always the team because, asset light means people. I think from that perspective, it's a huge benefit. It's a different mechanics in terms of entry multiples and valuation considerations. But I think what is a huge benefit for the LPs, I mean, they have always the choice, or that's what we offer. Either you can just, realize proceeds, or you can remain invested, or you can remain partially invested. So we actually give this full option model to all LPs. Of course, giving their nature, some of them just decide, well, it's a nice asset, let's go for the next 5 years and we fully reinvest. Others say, in particular institutional investors, we would like to, but our strategy is not secondary, so we have to get out. And then based on our history, we have a lot of family office also in private individuals. They often choose to do whatever they like both. And I think giving that optionality, and you have to do it also from a governance perspective, is a really strong, actually, like an argument to do that. I think what is super important is the governance aspect, right? You have to make it extremely proper. Always get the LPAC approval. All of our continuation vehicles have been unanimously approved by the LPAC. The way you play it and with the LP communication, I mean, it's a standard today, which was established, I think, the last 10 years for continuation funds. But if you play it very right, it's a great benefit. On the risk perspective, what are the major risks? I think it's a combination a little bit, of course. I mean, you have to respect your LPs, and I mean, also for us, right? We have to protect the interest of our existing investors. So this means, in a sort, we have to maximize the output. So that's good for them. On the other side, you're sitting in the buyer seat as well. So this means the entry multiple. That's a little bit of discussion, the price finding process, right? Is it too high? Is it too low? So that could be a risk. Also in terms of market timing, of course. That goes along, needless to say, with the leverage. The first vehicle we did in 2022, we were financing with debt funds, highly strong cash conversion business models to healthcare assets, which work along very well also today, including debt funds. I mean, they're expensive. Our last continuation vehicle, which we closed in September, there we had 3 financing banks. So we secured that upfront. And I think that could be a risk actually when you do a continuation vehicle, that you are buying in too expensive, in particular in these times now, and then might have a problem with financing providers. But that's more or less, that wasn't a problem, I think, the last maybe 10 years. But today, I think that's where many companies are struggling. And I mentioned that risk part. If you have a good, we are working with Park Hill here together. It was great, and also with you. And I think you have to take governance very serious. If you're not playing that right, that could be a risk to the transaction. But on the other side, there's a GP commitment alignment, which we will come back later, I think, which is a super important key. So if you're playing that well, I think there are definitely much more benefits than very limited downside.
Thank you. You spoke a bit about the GP and the current LP's perspective, but we were also curious about your take on what are the secondary buyers looking for. So which assets are most suitable for GP-leds?
Of course, I mean, yeah, absolutely right. I mean, I think we also have to differentiate our main funds. We have typical primary investors. We have also private investors. But, the primary investors who are giving us their money, I think their return expectations are definitely higher, like for secondaries. That's the nature of the deal. That does not mean that the secondaries are a bad deal. It's just I think for primary, our objective is at least 3 times. I think secondary investors might be happy with 2.5 times or something, right? Or 2 times. On the other side, the risk is much lower because the assets already. So I think what they are looking for, I think performance is key. That's what we see. That's the first thing they're looking obviously to have. Second, and that's what I just mentioned, I think, is the whole framework. Why are they selling? I think these points must be crystal clear. What is their future perspective? So is it something they're trying to get rid of their chunk assets? I think this is really, that's where the secondary market is coming from. I'm not saying that it's bad. It's just for the continuation vehicles. I think it's a different animal, actually. So all the secondary LPs who ask us, I think we really convince them that the strategy we implemented works and that we are capable of executing that strategy. It's a growth strategy with buy and build in the future as well. So I think that's a combination with performance and the rationale why we are doing that. Third rationale, I mentioned that we're just running out of money. I think that's a very clear point why you do it, right? It's not to provide liquidity or something. It was really, we want to grow. We're just missing the money. So I think this is in terms of from their rationale, that's very important for them. And then there's this huge topic, I just mentioned it, and I think this is GP alignment. So for us, it was a full rollover. Both vehicles, when we did them, they were subject to quite significant carried interest payments for us. So our GP commitment, we did a full rollover. In addition, we put additional money. So for all 2 continuation vehicles, we are the 3rd or 4th largest investors beside our lead or co-lead investors. And I think this is a super strong alignment. If you can see our history, we are not a 30-year-old established house. So this was significant for us. And I think LPs show that. So our GP commitments are above 10-12%. And I think that's a strong sign for secondary buyers, beside that the strategy is right, that we are actually all in. So we have quite something to lose if this goes wrong. And I think if you play that actually right, that works. In terms of your second question, Julia, is what are they looking for in terms of which assets are nice? I think buy and build is a really great story for GP-leds. Because you need more money, and that's so obvious. If you have not a buy and build story, I think the capital needs is maybe not that important one. Of course, there are multiple rationales why you do that. I think the core of every continuation vehicle should be growth. I think that's absolutely the key. So when you can show a clear path why it makes sense to keep an asset longer based on growth, I think those are really the suitable assets you can have. For us, I mentioned that's clear buy and build. I can give you an example. We transferred last year, we were building up a horse clinic. The name is Altano since 2017. This is really super small cap buy and build. We started with 1.5 million EBITDA with our first clinic. We started in Germany, then that worked out quite well. We went to France, Benelux, and so on. And actually, it took us 5 years to have the management and ready, to have the bookkeeping system, all that, CRM and so on, procurement and marketing. So it worked very well. And actually, then we were running out of money. So we extended our fund already with an NAV facilities. So that was our first way. And still after using that, we said, okay, why shall we transfer that? At that time, the company was doing 15 million of EBITDA, and we transferred it in April 2022, exactly when we were ready to scale. Now it's 1.5 or a little bit more later. The company this year has a forecast of a little bit over 30 million of EBITDA. So this means actually in 1.5 years, we doubled the size of the company. Before, it took us actually five years to go from 1.5 to 15 million. So some LPs might ask, what did you do the 5 years before? But I think that's exactly where we had that inflection point, right? Everything was set up, which took us 5 years to scale. Now you do it, and that worked out. By the way, this was the same for the second. That's a dermatological chain called Corios. It was the same there. We transferred it with 25 million, and they're above 40 million that year. So that's really a good and a very strong, I think, execution. And I think our investors are quite happy that really what we promised, we did. But of course, we have a large stake in that GP commitment. So I think it shows for these two examples. Of course, the other one, which we did in September that year, is too early to tell. It looks the same way, but it's just continuing the strategy on a more steady basis.
Wow, that's impressive in terms of continued growth and the track record that you just mentioned. In that respect, if you could also share some of your experience when selecting the lead investors and then building the syndicate, what were your attention points and the main drivers to go for one investor rather than another?
Yeah, yes. I mean, maybe a short back in history, we did our first. It was not called a continuation vehicle that time. It was a co-investment fund. Our first in 2016. Same reason, we were briefly running out of money, and then we hired what's a co-investment fund. We did a second one, but I think over the time, that what I mentioned before, that there was a standard established. We worked together with Parkhill very well, and also with you, and we learned how to set that process up in a right way, which starts, of course, with the lead investor process, doing the price building. We felt very comfortable. I mean, we first you have this preparation phase, right? So you start, that's really deep due diligence. You have these deep models, you put everything in a data room. I mean, you know the company very well, but of course the lead investor, they are very good names. I mean, that's public for us. The leads investor for our continuation vehicle we raised in 22, this was Stepstone, together with 5 Arrows, or this Rothschild. That year it was LGT, and very smart people, very nice people, and a lot of in-depth due diligence. I mean, you start with the lead investor, and then the syndicates are following. Of course, the syndicates look on the lead investor more or less. So the process was very well managed. I think as the rationale why we did the GP-led was very clear, and our alignment was so strong. It was a very efficient lead investor process. Needless to say, 2022 was a much easier. It was a more efficient market. I mean, we raised the fund. We started in December. We started November 21 actually, and we were done with the lead investor process by the end of the year. So it took us 2 months. That was very efficient. Then we continued with the syndicate process. That one's super nice. But of course, we then run into a Ukraine situation. So this was a tough one, because simply 3 or 4 investors had a program freeze. Nevertheless, we closed the fund, so this was successful, but the last weeks to get the final commitments was really tough, because I think at that time, in February, March 23, everybody was a new world. Everybody was waiting. What's happening now? So this was 22. So I think overall you have this lead investor first, and then the syndicates follow. I think most of them call the lead investors, right? And then they some simply follow because they know them. Some do an additional due diligence. And then we did in 2023 the same procedure again. The lead investor process took a little bit longer. Why? First of all, I think fundraising went really from full digital mode again to traveling. So this was nice, but also takes more time. The lead investor process took a little bit longer. I think that's quite normal. Questions which were, I think due diligence was even more in depth, but of course we have to secure the debt package. And I think this was a crucial part this time, that everybody said, okay, please, we want to make sure you have secured the financing banks. And I think that was a crucial part that time. So it took a little bit longer, and it was at the end of the line, the syndicate was super fast. The fund hit the hard cap, was oversubscribed. Overall, the process, but I think that's not a surprise. Everything took a little bit longer that year. But I think that's the overall market environment. Current year trading updates were more frequently. Just in terms of hesitation, I think everything is a little bit slower and more hesitant and a little bit more painful. But at the end of the line, we reached our objective. It was a huge success. But of course, now we have to deliver. Huh? I mean, that's that's what it is. But in terms of selecting, I can just advise everybody have an advisor, right? It's a very intense process. The due diligence is very intense. It really covers the management teams and covers the investment team. So it's a lot of work actually, but it's definitely worth doing it.
Thank you. Maybe a follow-up question on this one. So you said it's a lot of work and traveling to engage with investors. So what would be your advice to persuade the critical investor of the merits of engaging in the GP-led transaction?
What we learned, it's like always not black and white. By the white, there are the secondaries. You are simply focusing on the strategy, so that's relatively easy. Huh? They know what they are doing, and then you don't need to convince them more or less. It's their strategy. Then you have the other investors who simply still don't like continuation funds, right? They think the idea that you transfer something which is managed by the same manager does not feel right. And to convince them, to be honest, we were highly unsuccessful doing that, but that's actually something you learn in the first meeting. And then you have these, I think that's what you're referring, these critical, so let's say the gray part. So for that, really, I think if the strategy, what I mentioned before, I think our strategy was convincing, do more of the same, just running out of money and the GP commitment. I think if you can really, there were super strong arguments actually that, of course, you cannot convert all of them, but some said, okay, let's give it a try. And giving the market environment, and that's what we are seeing, I think there were billions raised for that strategy. So I think currently there are a lot of funds focusing on that continuation vehicle. I think that's the brand name now for that. Everybody knows, and I think it's absolutely great doing that. If I would do a secondary fund, I would exactly do the same strategy. If the rationale for doing it is nice, right? If it's growth, what I mentioned. So yes, so I think for us it was really, we convinced definitely some of these gray ones, other we couldn't, and those who simply said, guys, that's against our rules. We are not doing continuation vehicles. You don't need to convince them. In particular, if there are institutional investors, because then they're not eligible to do that. They're not allowed to do that anyway.
Thanks for this practical advice. Having just reflected on the past, I would now like to turn towards the future, and also to conclude the session, I would like to ask you, what, in your personal opinion, is the outlook for GP-led secondaries markets in 2024?
First of all, I think it's a growing market. I mentioned it in the beginning, and it's nice to close fund. I think it's one of the best innovations we had in private equity. I mean, there were not too many here, but I think this was a great one. I think the GP-led, and people know that there was many funds raised just to support that strategy. So there's a lot of dry powder. So this means I think the market is definitely growing. Absolutely. I think currently when we just went to conferences, there was one in Zurich. The hot topics now, I think, are GP-leds and NAV facilities. I think that's where the market is like it is. Huh? So I think going to the exit market now, if somebody, you see that, it's by the stats. 2023 was a super tough exit year, and 24, that's our opinion, might be cautiously optimistic, but it will still be tough. So what are you doing when you're running out of money? There are good reasons probably just to hold longer. So this will have an implication of price. I think the transfer prices to GP-leds might be a little bit lower, but I think there are good reasons now to set up GP-leds because everybody knows that a pure exit will not maximize the fund or the returns. Secondly, I think there are some funds coming just to an end, and if you're pushed or kind of violated into an exit now, which you don't want to do, a GP-led might also a very valuable way to just continue your holding. So I think my outlook is really positive for that one. But of course, the questions to due diligence, what I mentioned, will be very deep. But if there are good reasons to do it, that's a great idea to continue. I think the outlook is very bright actually, but pricing will be key. I'm sure about that. And of course, the financing, right? So the financing side needs to be secured, which is not a very easy one currently.
This is a great closing statement, and thank you for this positive note on the outlook for 2024, particularly after the last year, which was a little bit tougher for the fundraising, and we look forward to the silver lining on the horizon for this year. Marinus, I wanted to thank you for joining Julia and me today for this webinar and these very interesting insights on how Ufenau developed and raised its continuation funds. Also, thank you to the audience for attending this first session of the Arendt Secondaries webinar, and stay tuned for the next episode. Goodbye.
It was a pleasure.
Thank you for listening. We hope you found it interesting. If you would like more information about secondaries, we invite you to visit our website, www.arendt.com. If you don't want to miss our latest episodes, please feel free to subscribe to our newsletter to receive our invitations.